As we know, Ray Dalio has gained billions from the dot-com bubble and the 2008 collapse, but he is currently constructing the mother of all shorts. Recently, Dalio reported a $10 billion short position in Europe, but it is likely that he has also been amassing a much larger short position in the US market. What's good, you guys? This is Market Thrive, and today we're going to talk about how American fund manager and investor Ray Dalio is preparing for an upcoming global economic collapse. Before I start the video, I would just like you to do me a favor by just hitting that subscribe button and the bell notification down below to keep you updated on this channel. So without further ado, let's hop into it. The worst kind of crisis we are currently experiencing is stagflation. When there is both high inflation and a sluggish economy, this is known as stagflation. Over 8% of the population is now experiencing inflation, while the most recent quarter saw a drop in GDP. Due to the fact that stagflation frequently precedes a recession, this is very alarming. The economy of the last few centuries has been researched by Ray Dalio, who has noticed a trend. Usually, this cycle begins with growth in governmental debt, which temporarily strengthens the economy. Lending is a two-sided transaction between creditors and debtors, despite the fact that at first glance, this may seem irrational. In a debt, the debtor is the party who is owed the money, not the creditor. Both sides of the transaction cannot survive when there is an excessive amount of debt in the system. The reason for this is that someone else may own someone else's debt. A creditor is loaning out assets when they extend credit. The creditor will naturally wish to increase revenue if the debtor has taken on excessive debt because it indicates a lack of assets on the part of the debtor. The main issue is that when debt levels are too high, borrowers lack the resources necessary to make creditor payments. In order to pay off the debt, the debtor will be forced to liquidate assets. Evergrande, a Chinese real estate developer, is an illustration of this, as it had to liquidate assets to pay off debt. The results will be a weakening of the economy. Since the economy is weak, the central bank will print money to prevent a collapse. While creating money out of thin air may be effective in the short run, it is problematic in the long run. Simply put, money is value representing paper. Respecting the worth of that paper will inevitably cause it to lose some of its value. The central bank's decision to decrease interest rates will therefore cause prices to start increasing. The first result is an increase in debt levels. The economy then suffers as debtors stop making payments on their debt. For the purpose of boosting economic activity, the central bank prints money as a result. The fundamental issue of a sluggish economy has persisted throughout. The only distinction is that creating new money creates inflation, a brand new issue. Stagflation is the current state in which we are. We have a poor economy and high inflation as a result of the fact that printing money does not help the economy over the long term. As a next stage in the pattern, the central bank will raise the interest rates to slow the economy. This has nearly always resulted in a recession or depression in the past, Dalio has seen. It cannot be prevented in any way. Inflation gets worse if the government keeps issuing more currency. By taking money out of the economy, the only way to combat inflation is to sabotage demand. The middle ground between the peak of a debt cycle and a significant economic recession is, in other words, stagflation. Since we are currently experiencing stagflation, a recession or depression is the next logical step in the cycle according to Dalio. Quote, stagnant essentially means slow growth. That happens through this monetary situation that I'm describing, in which the central bank tries to deal with the middle course. In other words, what does the central bank want? Not too high inflation and not too low growth. And so when there's a lot of debt because one man's debts are another man's assets, it just becomes a very difficult balancing act. And that is when you have stagflation when you produce it, end quote. At the very end of the interview, Dalio was about to declare that stagflation comes before recessions when the interviewer abruptly cut him off. The 1960s marked the last time we had stagflation. The government incurred debt to pay for food and armaments because of the Vietnam War and social initiatives. Money that is backed and issued by the government, on the other hand, is known as fiat money. Due to the US government's sole control over the value of the dollar, it serves as an example of fiat money. The transition from fiat to commodity money took place in large quantities in 1971. Stagflation puts nations at risk of losing their fiat money, especially if the government decides to keep producing money. A prime illustration of this is Zimbabwe's hyperinflation in 2008. Because the governments made the error of printing more and more dollars, the Zimbabwean dollar endured a daily inflation rate of 98%. People believe in fiat money, which is why it has value. The US dollar's value will plunge if people stop believing in it. Furthermore, as the value of the dollar declines, more people lose faith in it. The Federal Reserve is really worried about the positive feedback loop. Consequently, what type of recession are we discussing? In 2021, they pushed the gas all the way down, sending the automobile lurching ahead. They are currently hammering on the brakes, causing the automobile to lurch backward as a result. In 2021, the Fed produced $1.5 trillion in new currency each year. In turn, this caused a 25% increase in company pre-tax earnings, the biggest rise since 1976, the highest gain in corporate earnings since 1948, and post-tax profits rose by an additional 37%. With a $1.1 trillion yearly rate reduction, the Fed is currently reducing the amount of money in circulation. A crisis of that size is set to occur, but it will be negative, which is not surprising. In the 1970s, there were two recessions that the US experienced, the first beginning in 1974 and the second beginning in 1979. Fed Chair Paul Volcker was the sole person who helped the US overcome this catastrophe. In an effort to curb inflation, Volcker increased interest rates in 1979. Due to this, there were erratic changes in the economy with Volcker's administration seeing the GDP primarily decline. The fact that other nations suffered more than the US is more significant. Debtor nations were thrown into depressions that lasted for 10 years, with people and businesses being, quote, painfully pinched and cutting back on spending. Dalio explained how inflation was lowered. This time will be no different, as it always is. As was already mentioned, money printing in 2021 led to an overstretch in the capital markets. In order to determine whether equities are overvalued, Dalio utilizes a bubble gauge which allows him to know this. In this graph, you can see how Dalio's personal bubble gauge classifies bubbles into percentiles. The bubble gauge reached its 99th percentile of bubbles during the 1920s. Similar to the 1980s, the 1990s spent several years near the 99th percentile before collapsing. Prior to the most recent crisis, the 2020s were in the 40th percentile of bubbles, ranking in the 85th percentile overall. So based on Dalio's indicator, stocks are actually undervalued. According to Dalio's indicator, the bubbly business have really fallen below the mean. In spite of this, Dalio believes that the bubble stocks will continue to decline. Since the 1990s and the 2020s are relatively similar, Dalio is basing his forecast on historical data. Due to favorable monetary conditions, growth stock valuations significantly increased during each of the 3 decades. This gave him the opportunity to look at historical patterns and anticipate the future. In all 3 instances, Dalio plotted the Nasdaq's yield on 2-year Treasury bonds. There are still more negative aspects of the current bubble than there were in the 1920s and 1990s. The leverage gauge is yet another tool that Dalio employs. His leverage indicator evaluates the market's position, options, and margin debt. We are currently at the 50th percentile of the data set according to the leverage gauge, which is roughly average. Some investors might conclude that there is still little known to risk as a result, but Dalio disagrees. He has observed that, to return to the automotive analogy, bubbles frequently overcorrect. Bubbles frequently swing more widely than the fundamentals indicate, similar to how the economy fluctuates back and forth. Although the market's current average level of leverage may appear adequate, bubbles frequently overcorrect to the 20th, if not 10th, percentile. Dalio stands to profit immensely from the impending overcorrection. According to reports, he is short $10 billion worth of equities listed in Europe. He is shorting stocks that are comparable to those in the Euro Stoxx 50 index, an indicator that measures the top 50 largest stocks in Europe. We are unsure if Dalio has a short position in the US market because the SEC does not mandate that investors report their short positions. Having said that, I wouldn't be shocked if he did, especially considering his short position in Europe. Furthermore, Dalio thinks there is a 40% probability that the US would see a civil war in addition to a recession. So what do you think about Dalio's economic strategy? Do you think the same? Feel free to jot down your thoughts in the comments section below. If you enjoyed today's video, please leave a like. If you want to stay updated on our posts, hit that subscribe button as well. Once again, this is Market Thrive signing off.